Hello again, investor. It's Mike Chupka here from Power Options with another $1 million options investing question and response. What is a $1 million options investing question? Well, to me, I feel it's a question that speaks for most, if not all investors at one time or another in their trading cycle. A question that questions or challenges the roots of options investing. Something that addresses a myth or legend of options investing. It's not necessarily strategy specific. Benefits beginner, intermediate, and advanced options traders. Gives other investors the chance to chime in with their thoughts and teaches me something as well. Some quick examples of $1 million options investing questions is, can I learn how to trade options? Well, absolutely. That's one of the reasons why we are here for you. Can I make money trading options? We think so, with the proper guidance and the proper expectations. Can I beat standard market performance using options? Done correctly, we absolutely feel yes, you can. Are options a zero-sum game? Nope, and we're going to reflect on that more in just a moment. And of course, options are too risky. Why should I trade this way? Well, options also give you the best way to control risk when done correctly. And why we're here today? Do 85% of options investors lose money? Now, this is a question from our open discussion Q&A session we had on Friday, November 1st. David asked this question mainly as he was paper trading naked call positions and naked put positions. And by the time we had our Friday session, all of his options were in the money and losing value. So we polled our other attendees in the webinar to see their thoughts on, do 85% of options investors lose money? Well, first Sam commented, and he's a regular on our Friday discussion. And he thinks that straight options buyers, those just buying a call or buying a put, hoping the underlying moves in their direction, that 85% of those using just that approach will lose money long term. How can buying a call or buying a put lose money when we see all of those emails that are out there that tout 8 out of 8 trades profited 300% in less than 10 days? Yeah, but they opened 24 trades over the course of the entire month. What are the results of the other 16 trades, 2/3 of what they're referring to? Start banking gains like $2,125 on Goldman Sachs, $2,136 on Splunk, or $4,080 on Trade Desk. Triple-digit gains in 7 days or less. Only 5 spots remain. And those probably were recorded gains. But do we get to see the recorded losses? Do we get to see the positions that were rolled because they were losing and capital is still being held because they have not yet hit a profit? We have to be careful with some of these claims and some of these ideas. Is this to say that buying calls and buying puts are a bad idea? No. But what stocks do we usually think of that are going to have the big moves? They're the ones in the news. The one where there's accelerated volume, option volume, and activity. Those with higher implied volatility and a known event, whether it's earnings, pending patent lawsuit, a drug release, drug trial result coming out in the near future. Which means buying those calls that everyone else is interested in, buying those puts that everyone is saying is going to fall, is going to have a drastically increased implied volatility, and we're going to have to pay into that extra extrinsic value. 2 out of 10 of those 10 trades may have the large move you need to see the success you want. We're talking 10, 12, 15% movement up or down on the underlying. 6 out of 10 positions you open might only see a 3, 4, 5% move. That's not enough. You needed 7, 8, 9, or 10 because of the increased implied volatility. So you're probably taking a 50% loss with the volatility crush. And 2 out of 10 might go the opposite direction. So you lose on the volatility, and your option effectively might go to 0, so you're near closer to an 80 or 90% loss in that position, assuming you can get out in time. So where would that leave us? Let's say I opened 10 long calls. I invested $500 into 10 different option positions on 10 different underlying securities. So we have $5,000 invested. 6 of those 10 that lost 50%. We would have had $3,000 invested in those 6, but we lost 50%, so we're only getting $1,500 back. 2 out of the 10 maybe had the move we want, but it was in the opposite direction. Earnings let us down. Some other event came out. The news that people were waiting for disappointed. So we only get $200 back of the $1,000 we had in those 2 positions. And 2 out of 10 move up, we get 100% profit. We get $1,000 back of the $1,000 we invested in the positions. But overall, we only get $2,700 back of the $5,000 we invested. We're down $2,300 or 46% loss. So naturally, we need higher wins. I'd probably need those 2 out of 10 to see a profit of 300%, 350, maybe 400, and that's possible. Or we need a better win ratio to be right on 3 out of 10, 4 out of 10, 5 out of 10. But again, that becomes tricky because of that high implied volatility due to the known event or the fear of the underlying. We might only see 2 out of 10 that have that large move that we need to see that 300 or 400%. Again, only moving 3 or 4% when buying into that high implied volatility, the newsworthy securities that everyone's tracking, everyone's talking about, well, they might see a 50% loss of the volatility crush. 2 out of 10 might go the wrong direction. We're at 75, 80, 90% loss. Now, Sam goes on to say that, look, even in 2008 and 2009, when the market was down significantly, 50% of put buyers lost money because they paid into too high of a volatility. This, of course, is very possible. I don't have the exact numbers. We're going to leave that for another webinar to see what would have happened at buying puts at the higher end of implied volatility in 2008, maybe 2009. Would this decrease in value across the market and the securities, taking an example of SPY, been enough to counter the crush in volatility? On the left here, we see the VIX daily chart from January 4th, 2008 to June 10th of 2009, about a year and 6 months almost. And at the time when there was a lot of fear and there was a big decline started to happen, when we saw SPY drop from 130 down to 70, we saw the VIX start to hit around 80, 85, 90. And then as the market started to ease, we saw it decrease down. So even as the market is falling, we're losing volatility of 80%, 90% down to 40% and 30%. A little jump back up to 60, little back down again, and then ending down at 30 as the market starts to recover. And that's interesting to see, isn't it? A low volatility in the 20 and 30 range when now we're around 12 or 13. But that's why Sam's comment, even 50% of put buyers during the steep decline lost money because of the crush of the volatility. That's very possible. Now, that was Sam's thoughts related to options buyers. This 85% of investors, options investors who lose money, is related to buyers. Jerry added his comment that, look, if 50% are winning, 50% are losing. If there is a winner, there has to be a loser. Options are a zero-sum game. Not necessarily. Yes, there needs to be a buyer for a seller. If I sell to open an option, it needs to have a fair market. It needs to be a buy to open on the other side. But you don't know what else is in the account of Joe the option buyer if you're selling an option. It could be part of a different combination. Let's say I wanted to open a bull put credit spread and the stock's trading at 290. I might sell to open a 270 put and buy to open a 265. Looking for a good bull put credit spread return, maybe around 12% or so with an 80-85% probability. Now, to make the market fair, there needs to be an option buyer at the 270 strike I'm selling. And we need to have an option seller 265 at the option that I'm buying. So is the opposite the opposite? I've entered my bull put. Does this mean that the other investor entered a bear put debit spread doing the opposite transactions? Did they sell the 265 to counter the bought 265 in my bull put spread? And did they buy the 270, taking a bearish position with a deep, out of the money, speculative bear put debit spread, where the stock's trading at 290 and would need to fall 25 points in order to hit the profit? Probably not. The investor selling the option, the put option at 265, could just be a cash secured naked put position. And the one buying at 270 could just be speculating that the stock's going to fall. So here we have 3 transactions where I've entered my bull put credit spread, sold to open the 270, bought to open the 265. The counter to that, a naked put trader, sold to open a 265 cash secured put, who is also bullish on this position. And then a third option investor who bought the 270 put, speculating that the stock would fall, but it doesn't. The stock moves up. Is it 50-50? Not exactly. 2 out of 3 investors made money. Yes, we can say that my put lost value, my 265 put lost value, but I wanted it to expire worthless because I made more on the other transactions. But there's more. That buyer at the 270 strike could also be doing a bull spread with higher strikes and a lower probability. They could be buying the 270 and selling the 275 to look for a higher return bull put credit spread. In this case, if the stock moved up, all 3 of us would have profited. Of course, now we have to cover a buy on this extra 275 that they sold. But still, this bull put, the bull put I was in, and the naked put seller would have all profited. And if someone bought that 275 and they lost when the stock went up, that's still 75% of the investors in these transactions made a profit. But what if the investor buying the 270 put that I had sold for my bull put spread owned shares of the underlying as well? Now I've got my 270 sold put countered by someone who bought that same 270 put, but they own stock, so they have a bullish married put position. My bought 265 put to complete my bull put spread, transaction is completed by someone selling to open the 265 put option as a cash secured put option, naked put position. The stock goes up. 3 investors, 3 profits, 100% win rate with a bullish move, even though we're all using put transactions. It is not a zero-sum game. Yes, the buyer of the 270 put lost on that particular put if the stock goes up, but they still could have had a profitable position if it was part of a bull put credit spread with higher strikes, a married put position, or possibly some other ratio spread or back spread combination. Yes, I would have lost on the 265 put I bought to complete my bull put spread, but I wanted to because I made more money on the 270 strike put. The 265 is there to control margin, to give me the return that I want. The key is we don't know what the other structure is involved with the opposite transaction. So even if I make money buying a call, I can't necessarily assume that the investor that sold the call on the other side lost money, because I don't know what else is in their account. Now, Robert added his thoughts into this. Robert feels, as Sam did, that options buyers lose long term. Robert also took this time to reiterate that you need proper position sizing and a good risk-defined position and trading plan. Meaning, if you're going to be buying long calls and long puts, you can't just go willy-nilly into it. Not only do you have to do the stock research, but you can only risk what you're willing to lose, assuming the worst-case scenario. Robert doesn't have the exact statistics, but his experience from his own account and discussions with others led him to believe and led him to see that just buying calls and buying puts long-term usually results in losing value. He went on to add to us that his thoughts on limited risk trades, proper position sizing, controlled risk positions, is maybe going 60 days out in a good risk-defined structure, such as maybe a low-risk, long straddle, long strangle, or again, best choice, possibly a married put position that only carries a 3, 4, 5% risk, possibly further out. I'd prefer further out than 60 days. Now, Fernando also added his comments to David's question, and he feels that this 85% of all options investors lose money quip that's out there is that the results are more based on psychology, not the actual trading results. This kind of points to an idea that the 85% of investors lose theory is more about the frustration of a segment of the options market that lost money, not necessarily the actual statistics of how many investors lose over time. That most who try a strategy do not have the proper education, the proper position size, as Robert mentioned, and will lose and assume psychologically that if it didn't work for them, it's not going to work for most of the people who attempt to do it. The thoughts in the webinar room to David's comment. Sam feels that this 85% of options traders lose money is referring to just options buyers that don't have a full trading plan. They're just buying calls and puts using leverage, hoping things go up in their direction, win some, lose some, but then they start to realize that when they lose, they're losing 90%. When they win, they're only winning maybe 120, 130%, but they're actually losing 60, 50% of the time, and you can't get ahead. Jerry commented that if you have a winner, you have to have a loser. Options trading is a zero-sum game. I think we've sort of seen that that's not really the case, because done correctly, we can use them in different ways to control risk, not really increase risk. That just reinforces Robert's comments that focus should be on defined risk, a quality trading plan, and position sizing. Fernando said that 85% idea is likely inflated from the psychology aspect of investors. What are your thoughts? Take a moment here, pause the video, go down into that comment section on this YouTube video. Let us know what are your thoughts. Do you think it's true that 85% of all options investors lose money? Let us know. Let the world know. Let us know your thoughts so we can all get together and have this discussion right here in the comments field and beyond. Okay, well, what are my thoughts? Well, my thoughts and my actual trading is that I have never been profitable long-term just buying calls and puts. Even with different technical indicators, fundamentals, trying different approaches, and long-term, I mean trying that technique of buying calls and buying puts consistently for at least 3 months. Not necessarily buying options that are 3 months out of time, but following the trading plan, doing it, paper trading it, and trading it for a 3-4 month period, never really seen good profits. I've sort of switched to straddles and strangles. Ernie's approach for straddles at earnings, using the straddle position to take advantage of earnings moves. You can see his introduction to that on Power Options with the Intro to Straddles video. Also, from time to time, I may buy 2 to 4 month out long strangles on ETFs. Buying a call out of the money, buying a put, having a low risk, as Robert mentioned. And as the market fluctuates up and down, I might roll the call or the put, sell premium against that to create a spread on one side or the other as well. But I've never been profitable long-term to a target goal I wanted to achieve with straight buying calls and buying puts. What is also in my thoughts? Myth. M-Y-T-H, the first 2 letters of each word. Let's take a look at some other popular options myths. We've already sort of debunked the one that options trading is a zero-sum game. We also have this other myth that was out there for years and years that 80% of all options will expire worthless. This makes the case that 80% of options sellers are going to profit. And it helped those that were trying to sell the idea of strategies for covered calls, cash-secured naked puts, and more. The problem was it was extraordinarily misleading, and we know that this is not the case at all. The actual facts, just the facts. CBOE and other brokers got together, other exchanges got together, and found out years ago that this is the actual case. Only 30 to 35% of options will expire worthless. Approximately 10% of options are exercised, meaning that if I had a call, I might exercise that long option to own the stock, especially going into an ex-dividend date. Or if I owned a put, I might exercise my put to force someone to buy my shares of stock if I was in a married put. The trader takes advantage of their right to buy or sell stock. So going up to any expiration, approximately 10% of the options are exercised. Around 55 to 60% of the options trades are closed prior to expiration. Whether they were closed to roll the position to a next cycle to manage the trade, whether they were simply closed because 50, 60, 80% of the expected profit was made, or they were closed out of frustration because they hit their stop, their target loss on the position, their stop order, for example, and just got out of it with a loss. And then, not 80%, only 30 to 35% of the options expire worthless. Now, this naturally leads to other questions, and during the webinar, Caesar prompted in and said, well, how much of the 55 to 60% are closed? What percentage are closed for a loss? I don't know. And I don't think the exchanges know that either, nor do I think if the exchanges knew that information, they would divulge it. Further on from that listing on CBOE, where they broke down the numbers of what actually happens at expiration, that we're talking only 30 to 35% expire worthless, not 80. They said that having option expire worthless says nothing about the profitability of the strategy. Multi-leg strategies, such as the bull put credit spread we were looking at, can often require that one leg or more expire worthless, although the strategy as a whole is profitable. So, my 265 option would have expired worthless, but I made more on the 270 and the spread did exactly as I wanted it to. They go on to say that, look, options positions closed prior to expiration may be profitable or unprofitable. They don't know. And maybe you had a 3 or 4 leg trade and you only closed 3 legs and left the other 2 open to expire. It's a possibility. In their final comment, options that expire worthless may not be unprofitable if they were part of a strategy that involved other securities, such as covered call writing. My bull put credit spread is a profitable position. I had 2 options expire. And options that are exercised doesn't mean they're exercised at a loss necessarily either. I feel that this is taken care of 2, and potentially even 3, of these myths and legends. We debunked that zero-sum idea. We debunked, or CBOE did it for us, that 80% of all options expire worthless. And the webinar room feels that David's comment that 85% of options traders lose money is only related to those that are just buying options without a true trading plan, that it relates to a small niche of options investors who maybe came in with too little education or over-invested, didn't practice proper position sizing, and lost maybe 50, 60, 70% of what they were trying to learn to trade options with in their first expiration cycle. And it seems the room also feel that those numbers are inflated, whether it's due to the psychology of the investors that, hey, if I lost doing this, it has to be more of the norm. No one's really going to be successful as well. But then, of course, we're talking about all these percentages, these myths and legends. It looks like a powerful number. Hey, stay away from options because 85% of all options traders lose money. Hey, trade options and sell options because 80% expire worthless. Well, an old homerism of mine that's a favorite is, of course, that, Mr. Simpson, how do you respond to the charge that petty vandalism such as graffiti is down 80%, because Bart wasn't doing it anymore, while heavy sack beatings are up a shocking 900%? And the homerism is, well, people can come up with statistics to prove anything, Kent. 40% of all people know that. That's what we know about statistics and how we have to look into the statistics sometimes to actually see what's going on. But let's consider the underlying crux of David's question. David posed this idea to the room, and the reason for his posing this question was because the paper trades for his naked calls and naked puts he was tracking on power options were all in the money and lost on Friday's expiration. Now, first, he's using power options. David was using the search tool. And I can assume that maybe he was using the naked put picks of the day, weekly or monthly, that Ernie put together, or one of the other default searches. But we want to make sure that we follow the suggestions that Ernie used in that testing to get similar results. Second, although we, as options investors, say we can always find a bearish stock in a bullish market or a bullish stock in a bearish market, we want to make sure that we're in the right market for the strategy. Even though it maximizes premium, I don't necessarily feel personally it's a great idea to be selling naked puts and looking for bullish positions while looking at other stocks over here that I feel are bearish on. I'd rather follow the general market trend of bullish to neutral or neutral to bearish if that is the case. Third, let us use real numbers, not discuss statistics and results as well. And what do I mean by that? Well, using our backtesting tools and power options, I went back and looked at what naked put weekly picks of the day would have come up for our screen on Monday, October 28th, around 3 or 3:30 in the afternoon. Why that time? Well, that's because that's when Ernie did all of his testing, was to look at when the results were going to be processed. The results came up for the naked put picks of the day, monthly or weekly, usually done Monday afternoon for the next Friday expiration. The top three that came up were Peloton Interactive, 2146, selling the 4-day out November 21 put option for 45 cents or so. Stitch Fix, selling the 23 put on a $23.77 stock for about a 30-cent premium at midpoint. And NetApp at 55.86, selling the 54.5 strike 4 days out in time again for a midpoint price around 70 cents, 65 cents. And here down below we see the results, the close of Friday. The top three positions, Peloton, Stitch Fix, and NetApp from the weekly naked put picks of the day, all would have expired worthless for the maximum return. The next 2 or 3 trades were also successful. The top 5 all would have reached their maximum profit on those positions. But again, part of the testing Ernie mentioned, in addition to looking at the Monday for the next Friday series on the weekly naked put picks of the day, looking at Friday afternoon, is also that it should only be opening the top 2 or 3 positions. And now we would have seen a 100% success rate here with a desirable return on investment for 4-day trades. This is not a pick of the day. This is not something that we've tested extensively because honestly, it's not a strategy that Ernie and I advocate. Doing the naked call positions, you need to have much higher trading approval to do it. It's usually about less than 1% of the total users on power options will access the naked call search by symbol, and other tools. But on Monday, around 3:30 p.m., close to the close of business, the 3 naked calls that would have come up on our default weekly search were Overstock, selling the 12 strike call on $11 stock, CrowdStrike, out of the money 49.5 strike on a stock at $47.95, and Slack Technologies. The top 3 positions would have expired worthless on Friday for the full profit, pretty much close to it, it looks like. Overstock ended at 10.31. CrowdStrike at 48.50. We'd sold the 49.50. And of course, Slack Technologies ended at 21.94. The 22.5 call would have expired worthless. The 4th trade was successful as well, but we wouldn't have done that following the suggestions for the picks of the day ideas, which I would apply to this as well, only doing the top 2 or 3. And Snap, of course, the 5th trade down, did see a small loss on the position. But let me put that in perspective. I'm not trying to say that past results will equal what we just saw in that last trading week. Past results are no guarantee of the future results. And this is not to say that David did anything wrong. And this is not to say that every options investor is going to make money, or that every options investor is going to reach their goals. What we are saying is that the room and myself doesn't feel that this myth that's out there that 85% of all options traders lose money is accurate. We feel more along the lines that it's a niche of the options trading market. Maybe 85% of new investors that come in that haven't taken the time yet to educate themselves fully on the risks, on money management. They're looking for the quick dollar, over leveraging themselves. Maybe 85% of that group of new options investors loses money. But again, I'm going to prompt you. What are your thoughts? What do you feel about this 85% of all options traders lose money myth, legend, quip, or concept? Write it down in the comment section on this YouTube video. I'd love to hear your thoughts and get a chance to respond to it and start a dialogue as well. What are we trying to say? Using our knowledge, our patented tools, and the help from our friends, which help us as well, you can learn how to trade options successfully. You can make money using option strategies with proper structures and the proper expectations, and you can likely beat regular market performance with the proper approach as well. And of course, in addition to inviting you to comment on your thoughts about the 85% idea that all options investors lose money, you should also take the time to go over to powerop.com, put in your name and email address, and take a 14-day free trial if you haven't already. That'll give you access to our tools that we mentioned, search capabilities, adjusting the criteria to meet your needs using our default criteria as a starting point, plus access to myself and Ernie through coaching sessions, email, and phone calls, not to mention a virtual library of recorded webinars for options education, strategy, management techniques, and much, much more. Well, thank you again, ladies and gentlemen, for watching this video. I hope you got some useful information out of it. Once again, let us know your comments. Let's start that dialogue. What do you think about 85% of all options investors lose money?